We're here at REIT World 2010 at the Waldorf Astoria Hotel in New York City. Joining me is Mark Streeter, Managing Director with JP Morgan Securities. Mark, thank you for joining us.
Thanks, Alan.
Mark, have REITs done enough to clean up their balance sheets?
They've done a lot. I would say that there are certain REITs that are still in the process of finishing that cleanup. Developers Diversified, Kimco are two examples of some of the larger cap REITs that still have some more wood to chop in terms of deleveraging. But they're well along their way, and I think most REITs have either completed the program or have a game plan as to how they're going to get there.
And then one of the major policy initiatives of the Obama administration in recent months has been the announcement that they're going to be pumping some more liquidity into the system. How do you think this is going to be impacting REITs?
So there's good news and bad news. I think the good news is borrowing costs are way down. If you look at where REITs are issuing bonds right now, they're at some of the cheapest levels in history. So coupons and the cost to issue debt is very, very inexpensive right now. And I think added liquidity also makes it easier for those REITs that are deleveraging, for the Kimcos of the world that are selling assets. Their ability to sell assets increases as buyers have more access to financing. The bad news is we're seeing more competition for the REITs that are looking to grow. So as financing becomes more readily available, it's tougher for REITs to buy assets at some of the yields going in that they thought they were going to be able to purchase assets for just 6 or 12 months ago.
And of course, even though there might be easy money, there's also the issue of tight credit. Do you think that banks are ever going to get as comfortable with commercial real estate investment as they were, prior to the Lehman Brothers collapse?
I think when you look at the bank's approach to commercial real estate, you have to bifurcate their approach to REIT lending versus lending to commercial real estate on a mom-and-pop basis or something like that. On the REIT side, the REITs have done very well by the banks, by the commercial banks. We've had very limited defaults. We really only had the general growth situation of the big, large cap REITs for sure. And there, banks got paid in full. And for the most part, REITs are very good borrowers. In fact, they're the preferred borrowers. Where the banks got burned was on construction loans, mortgage loans, et cetera. And I should say, and we have the whole mortgage REIT industry. And there, that's a different set of circumstances. And there, the banks are going to be a little bit more gun shy and require certainly lower leverage, lower loan to values, increased protection, structural protections, and the like. So I think it's a tale of two cities. I think the REITs, the large cap REITs that are equity REITs and own income producing assets, they for sure are in the sweet spot. They're the preferred borrowers for the banks. I think if you look at the mortgage REITs and you look at the mom and pops and so forth, that's where the banks are going to be much more cautious.
Well, thank you very much for your time, Mark.
Sure. Thank you, Alan.
Sounds like REITs are in the sweet spot. For more information on this and other REIT news and analysis, as well as more coverage of REIT World 2010, check out REIT.com.